Hey everybody, Luke Gromen, FFTT. Hope you are well. Hope you're having a great week. We're going to do another weekly video here. We're going to break out some of our applause. So thanks as always for joining me. We're heading into what's hopefully going to be a nice weather Memorial Day weekend, long weekend for everybody. So let me jump right in. As always, thank you for submitting the questions. Really appreciate them. It's very thought-provoking. Really enjoy the interaction. So first one is from Gambi. Hi, Luke. As a subscriber to FFTT for over 3 years, I'm continually impressed by the remarkable accuracy of your macroeconomic forecasts. Thank you very much. Especially in the past 12 months. Few macro analysts achieve such precision in timing major market events. Notable recent examples include early overweight positions in gold and Bitcoin, well ahead of the broader market, strategic puts on most assets, including Bitcoin and the S&P 500, but not gold in recent months. Sidestepping Bitcoin's 25% sell-off in late January. I sort of did. I think I got caught a little bit on that, but I appreciate it. Accurate prediction of the move surpassing 135 and immediate market implications. Timely removal of puts on Bitcoin and S&P mid to late April, aligning with Bitcoin's recovery and S&P's bounce back. Anticipation of some short-term gold weakness tied to a perceived trade deal in the between China and Trump. Given your track record, how do you guard against overconfidence bias in your future forecast? Well, I appreciate the very kind words. It's been fun for sure. The question goes on. Investors like Warren Buffett, Sir John Templeton credited their success partly to distancing themselves from Wall Street's echo chambers. Templeton notably relocated to the Bahamas to gain perspective. Being based in Cleveland, Ohio likely helps you avoid similar noise, but what specific strategies or practices do you employ to mitigate cognitive biases and maintain your analytical rigor? Best regards, Scott. Thank you, Scott. Very kind words. Very flattering. I think you probably give me too much credit on some of it, but we have had a pretty good stretch here in terms of being able to see the ball. And so, thank you for your business. Thank you for your kind words. As anyone watching this, anyone involved in markets knows, investing is a very humbling and a very hard business. I think in many ways it's similar to baseball. When you're seeing the ball well as a batter, you have a really high batting average for those stretches. And when you're investing, batting average is very high, if you will. It means you're seeing the ball well. And in my view, that's always been a sign that the lens you're using or your process that you're using is working. And it's also, I think, critical. Having done this for 30 years in investing, you realize all such periods are temporary. And so I think understanding that, first off, is really critical. That all such periods where you're really seeing the ball well, when they're around, it's fun. And but you have to know that all of those periods do eventually end. To your point, I do think being in the Rust Belt in Cleveland, Ohio, for what appears to be occurring in the global monetary system, which is, I think, one of the biggest changes in 50 to 100 years, I think it's a huge advantage to being, and when you're looking at things from a macro perspective, for one key reason, which is that the periphery of a system sees the marginal changes first. Liquidity, when liquidity sucks towards the center, it's the periphery that dries out first. Cleveland's in the periphery. The Rust Belt is in the periphery. They see it before the core, like Washington, D.C. and New York City, of course. And so I learned that firsthand in the great financial crisis 17 years ago, 2008. So much so that what we were seeing in the periphery back then, I was in 100% cash personally by October of 2007. And I was warning close family members, like, hey, keep your bank accounts under 100,000, the 100,000 FDIC limit back then, because I had, what I was hearing literally left me concerned that there would be serious banking system problems, which obviously played out. But what I also learned then was, in the same way the periphery sees the liquidity withdrawal first, it sees the liquidity re-adding last. And so the Rust Belt sees the liquidity and saw the liquidity injection benefits later than Wall Street in the 08-09 timeframe. So, I mitigate that reality by, following the right accounts on X and having developed relationships over 25, 30 years in this business, that highlight I can talk about highlighting and seeing key policy and liquidity changes. In I think being here in Cleveland, we don't have to imagine what would happen if China wins, if China gets an upper hand. We already saw it happen in the Rust Belt. China already won 10 to 15 years ago. We know what that looks like. So I think it's balancing off those two understandings of liquidity, et cetera. Marginal change is much more noticeable on the downside in the periphery, and then understanding that you see it later in the periphery, and so you've got to compensate. And that's something I learned the hard way 17, 18 years ago, coming out of the great financial crisis. In terms of combating biases and maintaining rigor, I would say I take both a strategic and a tactical approach. What do I mean by that? So strategically, there's some big things that could happen that could change everything. Collapse of governments in Russia or in China, for example, or if leaders there are replaced with Yeltsin-like Western favorable leaders in both. If the U.S. was all of a sudden willing to really slash spending on entitlements or defense, or if they were willing to sit around and let Treasury auctions fail, those would be game-changing things that would require a rethink of sort of strategically, the analytical process, or the analytical views. If you saw a sudden, sharp, mysterious rise in baby boomer mortality rates when 70% of federal government spending is tied to entitlements, that would be a huge deal. It would force a rethink of a lot of the fiscal issues. So those are the types of things I'm watching for that would change everything. That's strategic. Tactically, I simply read voraciously and, a lot every single day, lots of different sources, Main Street sources, that are down the middle of the plate, if you will, both sides of the political aisle. As most of you know that follow me for a long time, I'm not really political one side or the other. I try to call balls and strikes as best as I see them. I read voraciously from authors that agree strongly with me. I read from authors, and I make a point to read authors and investors that disagree vehemently with me. And anytime I see something in any of those cases that it creates a splinter in my brain, as I've called it, or something that grabs my attention, or it surprises me versus my priors, I make a note of it. And a lot of times I write about it. Then a lot of times clients will see that in our work in ensuing days and weeks. So the last thing I would say in terms of this whole process is even when things get intense, as they've really been intense, up until about a week or so ago, for 4 or 5, 6 weeks. I was just saying to someone today, it feels like this year's, January feels like it was dog years ago. It was only 4 months ago. I'm not trying to day trade the tectonic shifts we're seeing. I'm trying to keep them in proper perspective, even amidst all of the volatility and noise. And the reason is best case, trying to day trade, 50 to 100-year tectonic shifts is at best case is going to be difficult, and worst case, it's going to create losses, and it's very likely going to cloud clear thinking. So there's no guarantee in continued success, but it's a process that has worked for me over time. It's been working really well recently. I'm hoping that it continues to work. But I appreciate the kind words, and I appreciate the question, because I think it creates an opportunity to kind of talk through and revisit, share the process, number one, but number two, revisit the process, make sure I'm still doing it, really understand what is being done that has, I think, really helped see the ball well in recent months, so I can hopefully keep seeing the ball well in months and quarters to come. So thank you. The next question is from Chris, Gen X navigating retirement planning. How in the heck do you do that, given where we are macroeconomically? Well, I can say, as a Gen Xer, I know some people think I'm a boomer. I've been accused as such on X. I'm not a boomer. I'm a Gen Xer. I was drinking from the fire hose and being sent out from from dusk till dawn by my parents, just like all you other Gen Xers. As a Gen Xer, I got hopefully 2-3 decades, hopefully, knock on wood, until retirement. To me, it is crystal clear that have some sort of major sovereign debt crisis, restructuring, etc., sometime over the next 20, 30 years. Now, it is, from a path perspective, unclear to me in the relative near term if it's inflationary. I think it's gonna be, but it's unclear if it's gonna be inflationary or deflationary. You can get AI, robotics, etc. You kind of get to the same place, but I can make a credible case either way. I lean inflationary, but loosely held. But critically, as we've highlighted many times, I think gold and Bitcoin win either way. Gold, either the debt is going to be made not good on a real basis or not good on a nominal basis, in which case policymakers will likely increase liquidity to make sure it stays good on a nominal basis. But either way, I think that's good for gold and Bitcoin. Volatility can be elevated, though. So I'm secularly overweight those for my own retirement account, and I'm underweight long-term bonds, especially Western sovereign bonds. And I own equities. I own some gold miners. I own some real estate that I think some of which has some uniqueness to it, right? Where it's not easily replicable. And then I go about my daily life. I do what I love to do. I do my job. I try to help my clients best my abilities. And, I watch baseball and I hang out with Mrs. FFTT as long as she'll have me. And, this has all happened before. As my friend Simon Mikhailovich says, there's nothing new under the sun. This has all happened before. It's just been a very, very long time since it's happened in America. And so ultimately, I think by the time I'm retired, we're in a new golden age, a new global economic renaissance. After the end of this fourth turning, which I think is coming in the next 5 to 7 years. But again, I think the next 5 to 7 years have the potential to be relatively bumpy. So, within all of those assets, I've also still have a good sized position in T-bills for optionality, for ballast, for some yield. Happy to lend money to the U.S. government in the very front end, but not for anything beyond that. So hopefully that gives some sharing of sense of as a Gen Xer how I'm thinking about retirement and how it could how I weigh things in my own mind. From LM, if you were to fast forward 4 to 6 months from now, and the S&P 500 is down 30 to 35% from all-time highs, what is your most likely scenario to have caused it? A spike in 10-year U.S. Treasury yields, some sort of devolution or devolution, I guess is the right word, of the trade war progress. In other words, look, we were all excited last week about trade war progress, and this week we've got some nasty grams going back and forth regarding AI chips of China, rare earths to the U.S. This could get ugly again. No one seems to be that worried about it yet, but it could. Military tensions with China or Taiwan. I think no one's too strong, but the Japanese bond market issues that we have seen this week, I think could absolutely be a trigger, possibly through triggering a 10-year or a issue in the long end for the U.S. as well. So the key, in my opinion, is less what is the specific trigger or even can it happen? Because it all can absolutely happen. To me, the key is not what's the trigger to a down 30, 35% from all-time highs, or even, can it happen? Because it can. To me, the key is how long would it last? Down 30, 35 is possible, in my opinion. Down 30, 35%, and it stays down for 3 months, 6 months, 12 months, 2 years. That to me is impossible. Unless the U.S. government is willing to stand aside and let Treasury auctions fail, let basis / government spending while 10-year Treasury yields go up and up, and basically interest crowds out the entire government budget as receipts fall, interest goes up, and so they have to cut entitlements, they have to cut the funding. I don't think that's going to happen in lieu of them printing money or injecting liquidity, whatever you want to call it. And so for me, the much more likely case, if we were to wake up and find at some point that, stocks are down 30, 35%, how long is it going to last? I think it can last 3 weeks, 4 weeks at most before it triggers a dysfunction in the Treasury market, which we just saw yet again back in February, late February. Stocks were going down, yields were going down in the 10-year. Everyone said, hey, it's all going according to plan, and all of a sudden 10-year yields start going up. And then they keep going up as stocks go down. And then we have Treasury dysfunction and around shortly after Liberation Day, and boom. Soon as the move Treasury volatility index hit 135, that was it. They came in, jawbone liquidity, trade deal, blah, blah, blah. They are who they thought we were, as Dennis Green said. Treasury vol is the best input, just like it was the Yell input. So I continue to structure my own views, my own portfolio around, look, down 30, 35, sure, it can happen. It just can't happen for longer than 3 or 4 weeks. And so I just want to stay, that's how long the U.S. government can last until the Treasury market starts to dysfunction. And that means my own liquidity, I want to make sure I can last longer than the Treasury market takes to dysfunction. And so I think from a liquidity standpoint, from a leverage standpoint, I don't think it's a good idea to be using leverage at all. But I think, from a liquidity standpoint, understanding, hey, they can only withstand down 30, 35% in equities until the Treasury market dysfunctions. And then that's it. They've been consistent on that for the past 6 years. So I think they're going to continue to do that. From Scott, Japan looks like it is losing control of the bond market. If this continues, what will be the near-term effects to the U.S.? I think it depends on reaction. So in the near term, what's happening in Japan with the bond market is not good for U.S. stocks, not good for U.S. economy, not good for U.S. bonds. Eventually, I think Japan will have to they'll have to go back to yield curve control. Maybe we do. I don't think we'll ever call it yield curve control. It'll be something else. Even Trump privatizing or taking out of conservatorship Fannie Mae, Freddie Mac, which he floated out last night as an idea, something they've talked about before. That can be a sort of liquidity injection for the U.S. If that liquidity comes, then you end up with, stocks, Japanese stocks go higher, U.S. stocks go higher, particularly in dollar terms. I would take a look at, if you look at just any number of stocks in the U.S., in late 2012, post the announcement of Abenomics, they all look like the same chart. It's whether medical, industrial, tech, it's all up and to the right once they launched Abenomics, because the liquidity that they were injecting into Japan was fungible across global markets through the dollar system, etc. So I would think that if the Japanese bond market, continues to struggle, particularly it impacts ours, one way or another, liquidity is going to have to be injected. They will face the choice yet again. Do we save the bond market? Do we save the currency? They're going to save the bond market nominally, and they'll sacrifice the currency. And how that's going to manifest higher stock prices in dollar terms, in my opinion, and higher gold, higher Bitcoin. So I think stocks continue to go up in dollars, but probably continue to go down in Bitcoin and in gold terms. And then the final question from Aki. I'm a full subscriber. Thank you very much for your business. I have 2 questions. Does it make sense the gold stocks will start to move much higher as investors become afraid to buy bullion at the current high price? And then 2, chance of things unraveling when we reduce debt to GDP. So I do think gold miners will move higher over time, possibly notably higher. With that said, I have always and continue to prefer holding gold bullion to holding miners in terms of just an allocation perspective. I do hold miners. It's smaller than gold. I think you always have to keep in mind, especially as governments around the world, even the Western ones, seem to be getting a bit, shall we say, crazier. There is an insolvent sovereign between you and your gold in the case of a miner. There always is. And so that is just something to keep an eye on in extremis. In extremis, there is always an insolvent sovereign between you and your gold. It probably will never matter, but in extremis it could. And that's something to keep in mind and something to be aware of. Second question of chance of things unraveling when you reduce debt to GDP. I think it depends on the means of reducing debt to GDP. If it's inflation and nominal GDP growth above rates, I think you're going to get a nominal economic boom. I think you'll get sort of everything up. I don't think the unraveling will be on a real basis. Inflation will be higher. Things will go down in gold terms. Things will really go down in Bitcoin terms, but they'll probably be up in dollar terms. But if it's done by nominal cuts, yeah, then things will absolutely unravel. Like gold works, dollar works, maybe Bitcoin works, maybe. But everything else, you go into sort of a debt deflation, and yeah, that would be quite the unraveling. And ultimately, even government bonds, the long end wouldn't save you because your receipts would eventually fall below interest. Because the government's receipts are so marginally dependent on stocks, which would really be coming under pressure in that case. So I don't think there's a very high likelihood of that happening, of major nominal cuts, because as we've always said, there's only three things they can really cut: entitlements, defense, interest. You cut interest aggressively, it's probably going to be inflationary. So there's really only two things you can cut that are deflationary, and it's defense and it's entitlements. And I don't think they're cutting either one of those aggressively anytime soon. So with that, I'm going to finish up for the night. Thank you, as always, for joining me. If you like these updates, check out FFTT-LLC.com for more information about our Tree Rings product, 10 most interesting things, brief synopsis on each, what grabbed our attention about it, if it's reinforcing a way we've been thinking about the world or changing a way we've been thinking about the world previously. And with that, everybody have a great long Memorial Day weekend, and I look forward to speaking with you all soon. Take care.